So we're going to look at the CVP analysis for multiple products. Okay, good. Now, this question that we're going to look at, the question is actually question 5 of the 2022 ICAN exams for the skill level. So the question is simple. It says Abayomi. We're looking at Abayomi PLC. Good. Abayomi PLC. So the first thing, as I always say, is go and look at the requirement part of the question. So requirement A says, determine the break-even sales in units for each of the products using the budgeted data. Okay, so let's go and look at the budgeted data. Now we have product A and B, and then we have totals. So we have sales value, we have production costs made up of material, direct labor, variable overheads, fixed overheads for A and B, and we have the totals. Then we have the grand total of all of that. And when you less all of this from the sales, you have the gross profit, which we have for A and B, and we have the totals. Then next after that, we have the fixed selling and admin expenses. When you remove that from the gross profit, you have the net profit before tax. We are also told that the budgeted selling prices of the product are A is 120,000 and B is 180 naira. That's 120 naira and B is 180 naira. Now let's delve straight into it. Requirement A says determine the break-even sales. So what is the formula for break-even sales? That's determine the break-even sales in units. So A, solution. A, we are looking for break-even point in units. Break-even point in units, that's what we're looking for. Now we have A. The formula for break-even point we know is what? Is total fixed costs all over what? Contribution margin, or just contribution if you want. Then you ask yourself, what is contribution? Contribution is selling price less variable costs. Now, in this question, we have the selling price for A. So we say selling price for A. We're working in thousands. B, we're working in thousands. Of course, naira. Okay? Don't forget that. But selling price per unit. Or let's remove this for now. And from the question, don't forget that you are working in thousands. Selling price for A. Let's say A and B. We are told that A is 120 and B is 180. Now, the selling price less variable costs. Do we have the variable costs per unit? We don't have them. We don't have the variable costs per unit. So step 1 is to determine the unit of production. Let's know the unit of production. Remember that to differentiate between your variable cost and fixed costs, variable costs are those costs that change in proportion, in sympathy with the level of activity. And fixed costs are those costs that remain unchanged. They remain constant as the level of activity changes. So in our question here, we know the selling price, but we don't know the variable cost per unit. So let's look at the question. Now, the variable costs that we have are made up of what? Material, direct labor, variable overhead. These are the variable costs, but they are in total. So it means we have to go and determine the unit of production. To get the unit of production, you simply divide the sales value, the sales total, the sales revenue by the selling price. When you get that, you know the unit that was produced. So for A, we have a total of how much? Sales, we have 8,400,000 divided by selling price of 120. Then for here also, we have, for B, we have 25,200 divided by selling price of 180. So you are able to get the unit of production. Here we say units produced. That's what we're getting. Unit produced is equal to, that will give us 70,000. So 70,000 units is what was produced. For this other one, for B is 25,200 divided by 180. That will give us 140,000 units. Now, if you add this plus this, 70,000 units plus 140 units, it gives us a total of 210,000 units. Okay? So we have this unit. This is the number of units produced. Good. Now let's look at, before we proceed, let's go and look at the proportion, because we're going to need this when you are doing a multi-product CVP analysis. You need to do what we call weighted. Everything you are doing has to be weighted. So we need to know the weight. What is A contributing and what is B contributing to get the total unit produced? So let's look at the ratio or the proportion. Now we can say 70,000 and B is what? B is 140,000. So A is giving us 70,000, B is giving us 140,000. The whole of this is giving us total, is giving us 210,000, isn't it? Now, the ratio is going to be in the ratio of 1:2. When you add this, you have 3, isn't it? So it means 70,000 has a weight of 1. It means 140,000 has a weight of 2. And it means their common denominator is 3. So we're going to use this much later. Don't forget it. These are the weights for product A, and the weight for product B is 2. So we're going to use this, okay? Good. Now let's go. Let's continue. Let's look at, we know our sales. We know our selling price. We have gotten the units produced. So now we're trying to get, what we're trying to do is to get the variable cost per unit. So let's do them one after the other. Now the variable cost per unit is made up of materials. The next one is direct labor. The next one is variable overhead. This is what makes up, from this question, this is what makes up the total variable cost. So we're going to get the total variable cost. Good. Now let's look at material for A. Let's say this is A and this is B. For materials, what do we have? Let's come down to do our workings somewhere here. Let's do our workings here. We can clean this. So for materials, we have 240,000 here, divided by the unit of production. The unit of production is 70,000. Okay? So when you divide this by 70,000, what do you have? This will give us, it will give us 2240, 123, divided by 70,000. This will give us 32. So we have 32 here. That is the material cost per unit, which is a variable cost. The next one is to look at our direct labor. Direct labor, this is 32. So we can erase this. Next one is the direct labor. Direct labor we have for A, we have 1120. 1120,000 divided by 70,000. What do we have? We have 1120 divided by 70, which will give us 16. This is giving us 16. Now go and look at your variable overhead. What do we have? Variable overhead is next. Variable overhead is also 120, just like the direct labor we have. So it means it is 120,000 divided by 70. So if we did it for direct labor and got 16, it means it's the same figure for variable overhead. So this will give us 16. Good. So we are done with A. Let's go to B. For B, we have, for materials, we have 50-40. 50-40. Divided by, what is the unit produced? For B, we got 140,000. So it's 140,000. Okay? 140,000. So we have 50-40 divided by 140. That will give us 36. So we have 36 here. Next one, let's go to direct labor. For B is 360. We have 360,000 divided by 140,000. Good. So we have 360 divided by 140, which will give us 24. We have 24 here. And last but not the least, for B, we have variable overhead. Variable overhead for B is 240. So you have 240,000 divided by 140,000. Okay? This will give us 240 divided by 140. That will give us 16. 16. So now we have the total variable costs for this. But let's total them to get total variable costs. So we can say total variable costs. For A, we have 32 plus 16 plus 16, 32, which will give us 64. So we have 64 here. Now for B, we have 36 plus 24 plus 16, which will give us 76. 76. So this is total variable costs. Okay? Now, don't forget that we're looking for the contribution. We're not looking for total variable costs, but we're looking for contribution, because the formula is break-even point in units is equal to total fixed cost all over contribution, or contribution margin. Okay? Good. Now, to do this, we need to get our contribution. So we say contribution or contribution margin is equal to, here for A, we have, what is the selling price? If you remember, our selling price, I think, is 120. From the question, we say 120 and 180. So here, we say SP is equal to 120. Here, SP is equal to 180. Now, so you say this minus this, and this minus this. So this will give us, for A, we say 120 minus 64, which will give us 56. 56 is our contribution for A. For B, our contribution is 180 minus 76, which will give us 104. Good. Now, this is what we have. Okay? Now, at this point, we're going to bring in this weight. We talked about weight before. So here, what we're going to do, we're going to say 56 is a contribution. We need to get weighted contribution margin. This is what we need. For multi-product CVP, what we need is the weighted contribution margin, not the single contribution margin. Now, to do this, we need to bring in the weight. So we already agreed that we have a common denominator of 3. Isn't it? Because we're looking at 1:2. That is the ratio. 1:2. Isn't it? So it means the weight of 56 is 1, and it means the weight of 104 is 2. So when you do this, what do we have? Here we have 56 plus 104 times 2, that should give us 208, I think. Don't mind me. 104 times 2 is 208. So we have 208. Now 208 plus 56 will give us 264. Equal to 264 divided by 3. So 264 divided by 3 will give us 88 units. So 88 units. Good. Now, so we have 88 units. Now, with this, we can now come and calculate. So this is the weighted contribution margin. But don't forget that our formula is total fixed cost all over contribution margin. That is weighted contribution margin. Are you with me? Good. Now, at this point, what do? Let's go and calculate our total fixed cost. The total fixed cost, we have the total fixed cost. If you look at our question, we have fixed costs. Fixed costs are those costs that remain unchanged. They remain constant as the level of activity is changing. So if you look at our question, we have two fixed costs here. We have fixed overhead, which gives us a total of 2240,000 plus, we say total fixed cost is equal to 2240,000 plus we have 8320,000. Now this will give us our total fixed cost is equal to, we have 2240, that's 2.240 plus 8320,000. So our answer is equal to 10,560,000. Now this is our total fixed costs. Now to get the question says we should get what? Break-even point in unit. Question says determine the break-even sales in unit for each of the products using the budgeted. So we're going to get the break-even point as a total, and then we'll see the weight. We'll now be able to separate them to know the one that is for A, to know the one that is for B. So when you say 10,560, you now say divide by the contribution margin. That's the weighted contribution margin, which is 88. So when you divide this by 88, what do we have? Let's say 10,560 divided by 88. That will give us is equal to 120 units. Now this is our total. This is the break-even point in units for the company that produces product A and for product B. But the question says we should tell the examiner which one is for product A and which one is for product B. So to do this, we are going to share this into two. Remember already we know that the ratio is 1/3 and also 2/3. So for A is having the weight of 1/3, whereas B is having the weight of 2/3. So if you say 1/3 of 120, so for A is 120 times 1, of course, which is 120, divided by 3. That will give us 40,000. 40,000 units. Whereas the balance, there are two ways to do this. You can say 120 less 40,000. That will give you 80,000. That's the balance for B. If you don't want to do that, you can also say 120, but under exam condition, you don't have time, so you have to be fast. So you can say 120,000 multiplied by 2, that will give us 240, divided by 3, which will give us the 80,000 naira. So for B, it's 80,000 units. Don't mix up naira with unit, please. If you are looking for break-even points in, this is a professional exam. If you are asked to get break-even point in units, don't go and write naira. If you write naira, you may be wrong. The exam, in fact, you are wrong. You are wrong if you put naira. So this is unit. So we have done justice to the first part of this question. Okay, we've done justice to the first part of this question. Now let's move to the B part of this question. Are we good? Thank you. If you have not subscribed to my channel, that's the Accounting and Finance Coach on YouTube, I urge you to do so. If you are studying for the ICAN examination questions at any level, or ACCA, or ICAEW, or CIMA, or any professional exam, ANA, I urge you to subscribe to this channel, because this is where we solve all questions. And as I said, this question was forwarded to me by some ICAN students who are at the skill level. And I'm doing it for them because they subscribe to my channel. You too can send me professional questions in accounting and finance to solve for you. But first, you must be following me on social media, and you must have subscribed to my YouTube channel, because that's the least you can do for me. I'm giving you all this for free. So what is the big deal in giving me a thumbs up by following me or subscribing to my YouTube? So please, let's learn together and make our society to be financially literate, okay? Let's increase financial literacy in the society. All right, we're going to the B part of the question. B part of the question says, calculate how much sales revenue must be made. This is really tricky. Listen carefully. It says, calculate how much sales revenue must be made. Here, we're not talking of units. Here, we're talking about sales revenue. Calculate how much sales revenue must be made to earn an after-tax rate of return of 12% of the revenue. Assume tax rate of 40%. Now let's go ahead and look at some assumptions. They made some assumptions. They say, assume that the following changes are made to the budget. So the first assumption, we're going to look at this assumption and see how we can twist the question, because the examiner wants us to make some adjustment to the question. Number one adjustment, they said, unit selling price of product B is reduced to 160. It was 180. So for B, we have selling price of A, or rather, let's do it this way. Let's say A, and then this is B. Selling price is 120. But we're told that now that B, that was 180 before, is now revised to 160. This is very important. Note it. 2, they said direct material cost is expected to drop by 10. So let's go back and get our variable cost all over again. To get our variable cost, we have material, we have direct labor, we have variable overhead, isn't it? And then this is A. So under A, direct material, that's material cost here. Material cost here, they say it is reduced, it's expected to drop by 10% for A. So what is the direct material? Direct material here is 2,240. 2,240. Isn't it? Now, divided by how much? 70,000. For us to know the unit, that's the variable cost, to know the unit cost of materials. This time around, we multiply it by, they say it is reduced by 10%. Percentage is 100. So when you reduce by 10%, it becomes 90%. This will give us what? This will give us, let's quickly do that. We'll say, cancel this, cancel this. In fact, you can cancel this and cancel this. So let's say 22 divide by, that will give us 32, multiplied by 0.9. So we have 28. We have 28.8. We are told that material, direct material cost is expected to drop by 10% for product A and 20% for product B. So for B, B is going to drop by 20%. So for B, we have 50-40. So for B, we have 50-40 all over 140,000. Don't forget the unit produced for B is 140, whereas for A is 70,000. Now say multiply by This time around, it's not reduced by 10%, but by 20%. So we have 80% here. If you do that, you have 50, 40 divided by 70. That will give us this. Multiply by 0.8. Let's do that again. So I say 50, 40 divided by 140 times 0.8. So we have 28.8. This is also 28.8. Good. That is for direct materials. Let's go to direct labor. For direct labor, let's see whether there's any adjustment. Adjustment 3. 3 says direct labor cost for each product will increase by 10%. It will increase for both A and B, will increase by 10%. What this means is that if 100%, I mean percentage is 100, so if anything is to increase by 10%, it means it becomes 110% over 100, which is 1.1. So we're going to say for direct labor for A, we have 1120 all over 70,000 120 divided by 70 multiply by 1.1 times 1.1. So we have 17.6. For B, we have 3360. 3360 all over 140,000 multiplied by 1.1. So we say 3360 divided by 140. We have 24 times 1.1. We have 26.4. 26.4. Good. So we are done for direct labor. Let's look at the next adjustment. Adjustment 4. Adjustment 4 says additional 456,000 naira will be spent on advertising, and adjustment 5 says 80% of total revenue will be derived from product B. So there is nothing on variable overhead. If there is nothing on variable overhead, it means it remains as it was before. But because we have cleaned and we don't know what we calculated before, we have to do it all over again. So that means for A, we have variable overhead is 1120 all over 70%. So 1120 all over 70,000. So we have 1120 all over 70. 1120 divided by 70, which will give us 16. So here we have 16. And then for B, we have 2240. 2240 all over 140. You know, this is 000, this is 000. So we have 2240 divided by 140, which will give us 16 also. So we have 16. Good. So now this will give us 16, isn't it? Now, having gotten this, the next thing is for us to get our total here. Let's get the totals. Total. All right, so the first one is 28.8 plus 17.6 plus 16. That will give us 62.4. For B, we have 28.8 plus 26.4 plus 16. That will give us 71.2. Okay. Good. At this point, let's ask ourselves, what are we looking for? We're looking for revenue. We're looking for break even. We're looking for how much sales revenue must be made. So to get this, and there's also target profit, our formula actually is you have total fixed costs plus target profit all over contribution margin ratio. This is what we are looking for. This is the formula we are going to apply. So we have total fixed costs plus total target profit divided by contribution margin ratio. Good. So we need contribution margin ratio and we need total fixed costs and we also need target profit to do this. So let me write it somewhere. Let's say total fixed costs plus target profit all over contribution margin ratio. This is what we need to get to where the examiner wants us to go. All right. Now, at this point, we know our variable costs, total variable costs. But what we need is the contribution. Let's get the contribution first. So to get our contribution, we can say selling price less this, so that we get our contribution margin. So our contribution margin for A is, we have 120 minus 62.4. That will give us 57.6. For B is 160 minus 71.2. That will give us 88.8. Now, having gotten this contribution margin, this is not what we need. We need contribution margin ratio because this time around we are not looking at units, but we are looking at naira, at value. So it means we need to work with what? Contribution margin ratio. Now, contribution margin ratio is simply your contribution margin divided by your sales. So we're going to take 57.6 and divide it by the selling price. When we take 88.8, we divide it by the selling price of B. So quickly, let's do that. So when you take 57.6 divide by 120, what do you have? You have 0.48. Now for B also, what do? You say 88.8 divided by 160. What do you have? You have 0.555. So we have gotten this, okay? Now at this point, what we need to do now is to bring in the weight. What is the weight? For the first question, our weight was 1:3 against 2:3. Now let's go and look at these questions, whether there's any weight adjustments. We are told that 80% of total revenue will be derived from product B. 80%. So if 80% is the weight of product B, if here is 80%, it means here will be 20%. This is the weight. So it means we are going to say 0.2 multiplied by 0.48. And here we are going to say 0.8 multiplied by 0.555. This is how to get it. So Now let's look at the answer. Here we have 0.2 multiplied by 0.48. So here we have 0.096. And there also what we have? We have 0.8 multiplied by 0.555, which will give us 0.444. Now when you add them together, what do you have? You have 0.096 plus 0.444. This will give us 0.54. So this is the weighted contribution margin. So our weighted contribution margin ratio is equal to 0.54. Now let's go back. Let's go back. Let's clean this place. I hope you are following. It's not so difficult. All you need to do is to be systematic and to remember your formula, okay? And know what you are looking for. Know what the requirement of the examiner is. So now, having known this, what is our total fixed cost? We are going to say total fixed cost. What is total fixed cost? Now, if you go, let's look at something there. The total fixed cost, is it remaining the same? The last one we did, the total fixed cost. Total fixed cost was 10 something. 10, I think. Let's do that again so that we don't run into any mistakes. If you remember, the total fixed cost, we said it was 8320. 8320 plus the variable, fixed overhead of 2240, which gave us 10,560. 10,560,000. Is there an addition? There seems to be an addition. If you look at the adjustment number 4, it says additional 456,000 will be spent on advertising. Now, somebody may be confused about that. All you need to ask yourself is this a variable cost or a fixed cost? Do you pay advertising for every level of activity? I mean, for every production you do you need to pay for advertising? Of course not. So it is a fixed cost. It is a fixed cost, and it's very, very likely a one-off, which is fixed. It does not matter whether you produce 10% or 20% or 30%. You are still going to pay the same for your advertising. So it is a cost that remains constant even as the level of activity is changing. So that's a fixed cost. So we say 456,000 naira will be added to our fixed cost. So say plus 456,000. 456. That is 456,000, correct? So when you add this up, it will give you the total fixed cost. Okay? So that will be 10,560 plus 456. 456. So that will give us 11,016,000. This is our total fixed cost. Now the total fixed cost is this. So we have gotten a part of the formula. Now we have also gotten this. Look at it. But we don't know what is the target profit. So we have, let's go and look at that part very well to know our target profit. Now they say calculate how much sales revenue must be made to earn an after-tax rate of return. So it is rate of return we are given. We are not given, they say after-tax rate of return of 12% of the revenue. So we don't know. So because we don't know, let's assume that that target profit is X. We assume that the target profit is X. So X now will be equal to what? Will be our total fixed cost, which is 11,016,000. Okay, plus something. Target profit, we don't know, but there's something we have there. So they said it is make to earn an after-tax rate of return of 12%. That means, let's do some workings here. Let's do some workings. So we say 12%. 12% all over 1 minus T. This is the formula for getting after tax. You have to know this. This formula is the formula you use. You get 1 minus T, where T is the tax rate. The tax rate there is 40%. That means you will have 12 all over 1 minus 0.4, which will give us 12 all over 1 minus 0.4 will give us, let's see that. That should be 0.6. Let's say 1 minus 0.4, that's 0.6. So 12 divided by 0.6 will give us 20. It means we have 20%. So that is our target. So if we say this is the target profit that we're looking for, we say target profit is equal to TFC, that is total fixed cost, plus, here they say it has to be 20%. We got 20%. They say to give us a rate of return of 12%, okay, of the revenue. So from the 20% we have, we can now say we can make this 20% is 0.2x. And then we'll divide this by our contribution margin ratio, which is 0.54. Let's erase this. Erase this. My marker is not cooperating. Is it the marker or the board? I'm unsure. Now, at this level, if you are not sure of this, let's take it one more time. We say X is equals to total fixed cost plus the target profit, which we say is, we have to get the after-tax rate, which they say they give us 40%. So we divided by 1 minus T, that's the 0.4. So we're able to get 20%. And that 20% is 0.2. 20% is 0.2. So because it is unknown, we are saying X is equals to total fixed cost plus 0.2x all over contribution margin ratio. In other words, this is the unknown. X is the unknown. And we know that this is 20% of this. So what do we do? At this point, let's cross multiply. If we cross multiply, we have 0.54x. 0.54x. Let me see what is happening. I think this is better. So it says 0.54x is equal to 11016,000 plus 0.2x. At this point, we can collect terms. Let the x cross to this side, so it becomes 0.54x. This is positive. Coming here becomes minus 0.2x, which is equal to 11,016,000. Now let's do this quickly. So if you do that, we have 0.54 minus 0.2, which will give us 0.34x is equal to this. X is equal to what? This over this. So our X will be 11,016,123 divided by 0.34, which will give us 32,400. Now, if we have 32,400, which is the total amount, the total revenue for the company, let's share it into two. We know that 20% is for A and 80% is for B. So we can simply say multiply by 0.2, it will give us 6480. So A has 6480. And then B you can say 32400 multiplied by 0.8, which will give us 25,920. So all in Naira. So this is our answer for, we have done justice to question 2. That's the B part of the question. We have done justice to it.